Hi, Professor. Good evening. Thanks for joining my presentation today. Let's start off. The first question is about finding out the bond will be trade at a higher price in the market. To find out this answer, let us assume two bonds, which is X and another one is Y. So this bond has the same coupon interest rate of 7% and like the yield to maturity of 8.5%. The only difference is bond X has a maturity of 8 years, where bond Y has a maturity of 10 years. Calculating the price of the bonds using the bond price formula shows that the bond X has a higher market value. The same result will be generated in case of 5 and 30 years bonds. Therefore, the bond B or 5 years bond will be traded at a higher market price. Now coming to question 2. The effect on market price due to interest fluctuation. So this second question is about the effect on the market price due to interest fluctuation in the economy. Considering the previous example, let us assume the YTM. Considering the previous example, let us assume the YTM for X has increased to 10%. So the calculation shows that the the price of bond X will drop to $839.95. So it can be concluded that due to the increase of interest rate in the economy, the market price of bond will decrease. So the market value of bond dependent upon the YTM, I mean the yield to maturity. As a result, an increase in interest will have a negative effect on the value of a bond. Now coming to question 3, the measuring price change due to interest rate fluctuation. So this question is about measuring the change in price due to interest rate fluctuation. The calculating the price change due to YTM increasing to 10% for both bonds, and bond X experiences a lower percentage in its price than bond Y. Therefore, like based on the example result, bond X will have a higher percentage change than bond Y. Now coming to the investment strategy. While making an investment strategy, two things must be kept in mind. The first is increasing interest rate, and the second is capital protection. The slowdown in the economy caused the yield to flatten over the time. The interest rate in the economy tend to rise due to inflation. As a result, the price of bonds with fixed interest rates and less attractive options. On the other hand, bonds remain safe investment in time of recessions. So they increase the demand for bonds and thus decrease their yield. Considering these two factors, my investment strategy will be compromised of investing bonds with fluctuating interest rate and lowering yields. Thanks, Professor. Thanks for joining my presentation today. Have a good one. These are the references I'm using for this presentation. And that's all. Thank you. Have a good one.